All right, so I'll talk about stock market structure and hopefully changing it so that we can use MPC beneficially to help the stock market structure. And I'm obviously by no means an expert in finance, so if you have too hard a question, I may have to postpone it for a year to answer it. So, but hopefully things will go well. All right, so this is the talk outline. So we'll first discuss what's the exact purpose of stock market, all right? And then, is there a problem with the stock market? Okay, and then we'll do some Eco 101 kind of crash course. Hopefully it will be only one slide. And then this is where it gets more interesting because we are trying to model information in equilibrium pricing, all right? And since in cryptography we basically deal with information and about privacy of information, so that's where we bring in our expertise, all right? Hopefully, and then we'll discuss some price discovery mechanisms, and we'll talk about this novel structure of stock market, which turns out it's actually antiquated. It was used way before we were around. So. And then we'll do some more analysis of more of an illustrative kind than any comprehensive theorems or anything like that. So, so it is mostly to show that with MPC, I mean, we can change the structure back to what it used to be, all right? And over the years or over the centuries, it has taken a wrong trend, basically. And mostly because if you ask an economics grad student, for instance, I mean, for them, the idea of MPC is just inconceivable, all right? So hopefully, like, we bring in our expertise, and we can change things for the better. Okay, so the stock market basically has two purposes. One is price discovery, and another is liquidity, all right? So price discovery is important because everybody needs to know what the price is, because you want to make an investment. You should have some idea of what the price is. And so in a more abstract sense, what it really is, in economics, people study price discovery because it kind of gathers all the individual pieces of information which is all over the world. People have something in their mind. They don't really know, but somehow the pricing mechanism discovers the price, and it helps everybody make a joint decision as to how to invest their money or the capital which is around, all right? So price discovery is really important, and this is how the economy works. It's been going on for ages. Price discovery has been going on even before people understood that price discovery is going on, all right? So it's like very fundamental human trait, or a collective human trait. Liquidity is basically saying that there is a market out there, all right? If you want to dispose of your assets, it should be done as quickly or in a reasonable amount of time without distorting the market, all right? So for instance, the Apple stock right now is very liquid. You want to sell 1 million shares, no problem. There will be enough people ready to buy it right away. All right, but if you want to sell tulips, all right, yeah, IBM, there may be 1 or 2 people who are still willing to buy it. Okay, so there are 2 kinds of stock markets, all right? There are many kinds of stock markets, but mostly we are familiar with the New York Stock Exchange and the NASDAQ, all right? And both of them run what's called double auctions. Basically, buyers are in there and the sellers are in there. Buyers are putting in their orders to buy stuff, and the sellers want to sell stuff, and some kind of matching happens, and there is a clearing, and the price is discovered, and trade happens, all right? So the main difference between NYSE and NASDAQ, they're both double auctions, but the New York Stock Exchange is obviously more traditional. It's been around for a much, much longer time. It is that there is a specialist for each stock. He's like a special auctioneer who will collect your bids and asks and keep them secret, all right? he will not disclose the bids and asks to people. He will just clear the market and announce the trades. All right. Whereas on NASDAQ, it's a centralized repository of, like a computerized repository, where everybody's bids and asks are in the clear, and then trade happens in the clear. All right. So that's the main difference. And NASDAQ is the newer one, and apparently even NYSE is moving towards this other trend. So what exactly is going on? So I think the main reason is that basically the specialist is not really trusted. All right. So you can put your buy orders in there. If you want to sell 1 million shares of IBM, for instance, that's a disaster for you, all right? Because if the specialist leaks it, all right, the shares are going to drop radically, all right? Yeah.
How does the New York Stock Exchange do price discovery then?
Oh, so okay. So the New York Stock Exchange is like a clearing price auction, all right, in the beginning of a day, all right? The first opening price is discovered using a clearing price auction. Then during the day, it's more of a continuous trade, but it is still, the bids and asks are still hidden. They are with the specialist. Whereas in NYSE, in NASDAQ, there is no clearing price auction. It's called a continuous double auction. All right, the bids and asks are out there in a table in a repository. The new ones come in as soon as they match, they're cleared, and so on. All right. So there is a problem, basically because the specialist is not trusted. All right. So the trend is towards the open system. If you don't trust the specialist, might as well go with the open system. And what people do is, if they have a huge order to sell, they do all kind of hiding strategies. Okay, they will sell 1,000 and maybe buy 100 back so that nobody knows what they're doing. So it's all complicated. There are all kind of algorithms out there. So that's why there is this chaotic trading going on day in and day out. All right. So that's what it is. And then there are these high-frequency traders who have written algorithms. They just sense the bids and asks in the market in the open, all right, and they try to figure out from that whether you have some special information, all right. So these are the problems basically. Okay, so now can we model all these things? All right. So obviously, this is what you learn in your economics first course in economics. There is this demand curve and there is a supply curve. All right. These are the prices, and that's the amount of demand. So at price 1, there's a lot of demand, but not many people are willing to sell. All right. And price 4, a lot of people are willing to sell, but there's not much demand. So that's like a clearing price. So that's the current price for that commodity. All right. So it's for a particular single commodity. All right, so we all know this. Okay, but what we really want to study is more interesting scenarios where there are multiple commodities, all sorts of assets people have. How is an equilibrium defined in such a situation? And Walrasian is a French economist who, way back in 1877, formalized this notion. It's called the Walrasian Equilibrium. There are N resources and M agents. And let's say we start off with each agent having some of those assets. Okay, that's their endowment. All right. So each one has some assets, which are like the agent I has EIJ of the jth asset. All right. Each agent also has a utility function of their total wealth. All right. So normally we know that as your wealth goes up, your utility doesn't grow linearly. Right. In fact, it's an exponential curve like that, all right? So for most people like us, it goes very sharply up and then just stagnates there. We don't want too much money, all right? But big institutions like mutual funds, which pool resources, they are more linear, all right? So those firms are called risk neutral, all right? Whereas we are risk averse, all right? So that's a very important characteristic to remember. There is what is called a risk aversion coefficient, all right? So for individuals like us, the risk aversion coefficient is very high, all right? Whereas for large firms, it's close to 0. So that comes into factor later. So I just want to remind you of that. So that's what an economy is, all right? There's the utility function of all the people or all the agents, and then this is their endowment. It's a vector. I've written E to EI as the vector. Think of their endowment in all the J components. All right, so that's the economy to start with. Now, what's an equilibrium? All right, so first of all, each individual tries to optimize their assets. So let's assume that the prices for all the assets are given to you. All right, somehow prices have been decided, all the prices are given to you. All right, so let's say there's a vector of prices, market prices. All right, so based on those market prices, each agent tries to maximize their utility. All right, so the agent Xi will want to find different allotments for his different resources. He started off like this, but he wants to go there. All right, and as long as his total money is less than what he started with, he wants to optimize the utility he gets from these Xi now instead of EI. All right, so he wants to maximize the utility under this constraint. All right, because he can't just generate wealth out of nowhere. So that's what a Walrasian equilibrium is. Okay, so you start off with an economy where there's utility function and the endowments. Then an equilibrium says there is a market price for each of the assets or commodities, and there's a redistribution now, which satisfies these two properties. Okay, first of all, each agent has maximized their utility. Okay, using this and that, and the market's clear. All right, so the trade happens. The sum total of each of the assets remains as before. So that's called a Walrasian equilibrium. All right, and that's a very fundamental thing. This basically says that if an equilibrium existed, this would be the prices in the world right now. All right, based on their current utility. Okay, so now the question is, how do you find this equilibrium? Okay, so Walras actually suggested a process called tatoma. Okay, it's a French word. So he suggested that basically everybody submit their bids and asks given the current prices. Okay, he will do a clearing, and then he'll announce a new set of prices. No trade will happen, but he'll just announce a new set of prices. Everybody, based on that, now resubmit their bids and asks. Then again, he does the same pricing. It continues forever and ever and ever till an equilibrium is reached. All right, so it's an endless trial and error process. In the end, when the prices are convergent, then the trade happens. Okay, so this is called tatoma. Actually, it's a French word for groping. All right. So only the French can come up with such a nice word.
So what do the bids and asks consist of if the prices are already announced? So just I'm willing to buy so much.
No, this is like a preliminary prices. Let's say from yesterday.
What do the bids and asks look like?
Bids and asks, like people will say, okay, for this price I want this much shares, and for this price I want to sell that much, and they can have all kind of combinations. All right? Yeah. So that was based on the previous day's price. Things have changed. There's more information in the world. All right? So now they want to find the new price. All right? So this process is like seemingly endless. All right? But, and in fact, it can be shown, like there have been papers written on it, that this process doesn't even converge. All right? There are instances of endowments and utility functions where it may not converge, this process. All right? But the stock markets, if you think about it, they're basically trying to do this. All right? This is what's happening in the stock market. Except that trades do happen, but those are small amounts. All right? In the end, effectively, over a whole day's process, there is this price discovered for each of the commodities or the stocks, and there is some final total net trade happened. So it's an approximation to the tatoma process. Only problem with it is in the NASDAQ style market, the bids and asks are open. In tatoma, the specialist is not supposed to reveal the bids and asks. He's only supposed to reveal the price at each instance for the resubmission of your bids and asks. So it's a very loose kind of an approximation which really doesn't work. All right, but people are still trying it. Okay, for lack of anything better, I guess. But wait, so there are more problems here. All right. So in 1980, Grossman and Stiglitz, they wrote a paper which is titled Impossibility of Informationally Efficient Markets. Okay, so till now we didn't bring information into the picture. Information was not being traded. There was no price involved with it. It was just commodities. Okay. So in finance, there is this whole notion of called efficient markets theory. What it says is that basically the price will tell you all the information you need to know. Okay? The price of all the assets already capture all the information. But what these two authors have shown that that's not true. All right? So let's see. Okay? So there are these informed traders. They've done some research. They spent a lot of money on it. And they gathered a lot of important information. All right? But if the price is already incorporating their information, they get no incentive in the final endowment process, all right? Because their information is already captured in the pricing, all right? So they can't be incentivized, so they will stop doing research, all right? They spent a lot of money on it, okay? So they will get rid of doing any research. So the equilibrium will be no one is doing any research, all right? Or the so-called equilibrium. All right? But that's not an equilibrium because at least one guy will figure that if I do some more research, I can benefit a lot. All right? So in the information economy, this Walrasian equilibrium or at least the Walrasian equilibrium is fine, but this efficient market hypothesis is actually invalid. All right? That the price reflects all the information, that is wrong. All right? So there is actually a model for this, all right? So in 2004, these two professors from Cornell, they came up with a model where they want to show that the price actually does not show all the information, all right? And then basically they say that there is a Walrasian equilibrium. If you do it correctly, then the price doesn't reflect everything, all right? But of course, importantly, that in this Walrasian equilibrium, the bids and asks need to be hidden during the process. All right? If you reveal the bids and asks also, that will give out your information. All right? Then you'll have no incentive. All right? So that's the important thing to remember here.
Can you explain a little bit in more detail what does it mean that the price contains all the information?
Well, basically, it says that you can simulate everything based on your price, all the assets. All right? Yeah. Well, let's not get there. All right, so that's what it's saying. Basically, the price contains all the information. So it doesn't even have to be recursive. It's just information theoretical. All right? So that's the assumption, obviously.
What exactly? What's is to be simulated here?
Well, everybody's utility. Okay, so one thing in a lot of this thing is that a lot of public parameters are already known a priori. For example, everybody's utility function is known, let's say. All right? Now you want to know what their valuation of a particular asset is on that particular day. That's the information it's saying it's revealed. All right? So that's the critical information. So from the prices of all the assets, and given that you know everybody's utility function, you can calculate backwards, like using Bayesian rule, okay, what the valuation of each individual is for each asset. All right, that's what it is. But when information comes into the play, that is no more the case. All right, so this model actually will try to show that. All right, so how does this model work? So all the things in the blue will be public knowledge. All right? So the way the public knowledge works is that that's a very interesting thing from our privacy preserving notions that we have. All right? Basically, they're saying that everything is public anyway. All right? So in a way, that's why Hugo and me, we always have this trouble that how come people are not interested in privacy? But maybe they follow this general equilibrium theory and think that everything is out there anyway. All right? So this, in this slide, all the blue things is, let's say, are public knowledge. All right? So everybody knows what the future distribution, let's say for tomorrow, for Apple stock, or even for a month out, is. Okay? So it's a normal distribution with mean 150 and variance 50 or something like that. So it'll be denoted by the random variable is V, and its average is V bar, and variance is rho. Okay? So that's public knowledge. All right? And all buyers are risk averse. You know their utility functions. You know what risk aversion coefficient each of the buyers has. You know all those things. Okay. You also know the daily per capita supply of stock, or at least its distribution, all right, which is you know the mean and its variance. You also know the total number of buyers. You also know the fraction of the informed buyers who actually do research, all right? The only thing you don't know is that the informed buyers will get a private signal, okay, S, but its mean and variance you still know, all right? And it's again a normal distribution. It may slightly be more peaked, all right? So over here it was normal with mean 150 and variance 50. This one will actually have the mean of the actual random variable, which is about to show up next day, all right? But it will still have a variance, and that's very important, okay, that this variance still be there, as we'll see, all right? This variance is extremely important that it is there, okay? So of course, you know, you can calculate the conditional probability of V given the signal, at least the informed buyers can, all right? And it will turn out that it is also a normal distribution, just with a slightly better variance, okay? So the normal curve got squished, all right? And its mean has also shifted a little bit towards the signal, all right? So initially it was V bar, and you got a signal S. Now suddenly, using Bayes' rule, you can calculate that you know the mean is around here, and the variance is slightly squished. The curve is squished, all right? So that's good news, all right? So what you can show under this model, and Easley and O'Hara show, that when you do the Walrasian equilibrium price for this, that price will only reveal S partially. It will not reveal S completely, all right? So that's very good news, because the informed traders have an incentive to do research, because their information is more precise than what can be revealed from the price, all right? This is a really nice piece of work, okay? And using Gaussians and all, we love Gaussians, so, and of course, I want to remind you that in this Walrasian equilibrium that you discover, it is very critical that the bids are hidden, because otherwise this partial will become complete information for everybody, all right? So then there's no incentive, all right? And the uninformed also get a return. You don't want to clearly, completely throw them out of the market, all right? Because then who are you going to sell to, okay? So, so the uninformed still get a return because you're risk averse and your information has a variance, all right? You don't really know whether that signal S was accurate or not, all right? So there is some variance in it, so you leave something on the table for the uninformed. In fact, the uninformed can just come in and buy at market price, all right? And because you are basically the big player, because you did all the research, you will be setting the prices, and the other uninformed like me and you can just go in and put market orders, and we'll still get something. All right. So here is the clearing price double auction that we propose should be the stock market, all right? And this, as I said before, it used to be the case that, in fact, even now, the opening of each stock in New York Stock Exchange happens this way, more or less, except that the specialist is a human being or a firm, all right? And they see all your bids and asks. Here, we're going to replace everything with MPC, all right? And now I'm not going to say which MPC instantiation to use, because there are a lot of versions and a lot of experts in this room. And then, of course, one of the research topics here is that what else can you leak, all right, so that you can make it efficient and still incentivize the informed, all right? Because as you will see in this one, with some leakage, you can make it much more efficient. And if you want to hide everything possible, it's obviously really difficult, all right? So the first thing, obviously, like we do in cryptography, is we will reveal the total number of orders. Because if you don't even reveal that, that's really difficult, all right? So most likely with that, no information is really leaked, all right? Now, since I'm running out of time.
I just had one question, which is, so you're saying that the current system where you're revealing bids and asks, that this is revealing too much information?
Yes, of the people who have done research.
And therefore, it's disincentivized to do research.
Right.
But reality seems to contradict this, right?
Why?
The percentage of money that's going to the people who are doing the research in this area.
No, they are the high-frequency trade. They're not really researching the stock. They're researching how you're trading. That's a different kind of research, which is not really useful research. Or you want to do research about how capital should be spent on which efficient companies. That's the research I'm talking about. All right? Those guys, and also, by the way, even if they're making money, it just means that you need to pay them money to use that information so that you can spend your capital better. All right? So you need to join the ranks. It's not like you want to get away from them. All right? So if everybody does research, it's actually good because the equilibrium pricing will be more faster to converge. All right? So then assets will be allocated more efficiently, much faster. All right? As opposed to just doing this groping process. All right?
This assumes that research actually gives the right answer.
Yeah, then that's the distributions. Okay. So the normal distribution is there. Not every time you'll do the right answer. And then, of course, it's collective. It's not one person.
The more you research, the worse you do.
That's also true. Yeah, so these are kind of philosophical questions which can be debated.
You're replacing the auctioneer with secure computation.
Right.
So everybody who wants, it's everybody who wants to buy or sell Apple stock, or everybody who wants to buy or sell a specific, any stock?
Okay, so there are different versions of this. I mean, we can think of it.
Everybody has to talk point to point.
No. So it will be again like usual, like they do for the sugar beets. There will be certain agents, brokers, and then there will be 5 trusted parties, let's say. So we'll go through those, all right? So not everybody is going to talk to everyone.
Can you say something more about the computation that's done in secure computation? Like what exactly is?
Well, this one is very simple. Basically, it's very similar to the sugar beets auction. All right. So except that we allow market price orders, and then the pricing clearing mechanism is slightly different from the sugar beets. All right. And because we want to make sure that the market orders are completely allocated, okay, in every clearing. All right. So that's one requirement because you don't want the market orders not to be allocated. There will be partial allocation for some of those things. Now that's a tricky one. That's what I'm talking about. There's some research issues here. What do you do about the leakage in the partial allocation? Is the probability leaked? And does that leak more information about the signal or not? There are a whole bunch of issues like that. So it's a mix of finance and how to make things efficient. All right. So I think my paper is online on ePrint since yesterday. So there are more such details there. So obviously I don't have much time. And I think I'll just like to stop now.
Questions?
Yeah.
So the sugar beet auction, I mean, it did the same computation, and it seemed like a motivation for that was this privacy thing. I don't think they claimed anything like that.
Yes, exactly. So this is different. This I'm trying to show that it's actually even more important. Yeah.
So is there any hope that?
Well, you can do this for, let's say, the S&P futures, all right, which is one of the most important things traded in the market, and most experts deal with that. So we can start with that.
Okay, thank you again.